loans given by banks is to households. Is there any underlying reason why this pattern, for example, changes here and this pattern changes here? This brings us to the main thesis, which is the choice of exchange rate regime is a fundamental choice for small economy with significant effects on all economic participants. When a central bank chooses a particular exchange rate regime, in effect, the central bank chooses an economic setup which will have significant impact on all other economic agents. The main impact runs through the FX risk. If there is an FX risk, the participants are going to behave in one way. If there isn't an FX risk, the participants are going to behave in another way. So the choice of the exchange rate regime leads to a distinct difference in economic characteristics for economies which have stable exchange rate versus economies which have variable exchange rate regime. Which both of these exchange rate regimes, stable and variable, will be defined. So what do we have here? Economy, one state, we have some kind of relationships, households, savings for banks, get debt from banks, give labor to firm, standard economic setup. And then we have the same picture. What's the difference? The difference is this line. Solid line, dotted line. So the basic setup, the economic setup, where these participants operate, is going to be different. And how different was, in what way different, was the main thesis, was the main investigation and the purpose of my thesis. We have that the whole thing starts with the process of transition. Process of transition is a complex one. There was a socialist system, then the socialist system changed to a free market economy. Different policymakers made different policy choices at different points in time. Basically, and the thesis gives mathematical example, there are two things. You can react and you can analyze and then determine what changes are necessary. Classical example is that some countries went with a really, really fast privatization of banking system. Some countries did not go with a fast privatization of banking system. And this is not just one choice. There are many, many others, including education, politics, but the end result of the transition is join the EU, join the monetary union, join the European Union. Within this, we basically have that one of the choices, one of the particular choices was the monetary policy. So what are we, as a country, what are we going to do with a monetary policy? Are we going to say, okay, the exchange rate is going to be fixed or stable, or are we going to actively use exchange rate for some purpose? Now, what can be the purpose? One of the purposes, like Professor Ribnikar says in his point in the dissertation, is to cover the uncovered interest rate parity. Another thing is control of inflation. Another thing is to boost exports. So basically the choice is, are we going to keep it stable or are we going to actively use it? Because when it comes to monetary policy in a small open economy, it eventually boils down to the exchange rate. So whatever monetary policy you want to have, if you're small and you have a free flow of capital, you will have to address what and how you're going to do with your exchange rate. This is the classical split of the exchange rate regimes. So you have the dollarization, monetary union, free or pure flow. In my thesis, I offered an alternate definition because this alternate definition was needed for the investigation. Stable exchange rate regime is a type of exchange rate regime where the exchange rate is either fixed or stable in a band, but over time, if you look at a time graph, the exchange rate doesn't go anywhere. So, stable exchange rate regime would be something like this. Variable exchange rate regime would be something like this. So over time, the central bank is keeping the exchange rate fixed, stable, within a narrow band. But the main characteristic is when we look at a graph, the exchange rate regime doesn't go anywhere. Here, we have that exchange rate as some kind of a time peg. This is the exchange rate regime of Slovenia. Started at 89, ended at 230. This is Croatia from 2000, started at 7.7, went to 7.3, now is at 7.3. So we do not see something of a clear trend. And then we have a pure free-floating regime, which there are some candidates, maybe Romania, but I did not go into deeper investigation of this particular regime. Modeling implications. Now, if we have two states of the economy, one under variable and one under stable exchange rate regime, we will have to model these two states separately. So in one state, the behavior will be determined, is there an FX risk? In another state will be determined without the FX risk. Now, there are other particular shocks to the economy. We can have a tax shock, we can have an outside external shock, but all these shocks were put aside because the main premise is there a difference in behavior given the exchange rate regime? So, as I said, we have defined the states as stable and variable, and the model, which is presented in the thesis, clearly states, okay, we have one state now, this is the behavior, we have a second state now, this is the behavior. Also, in the thesis, there's a process of learning how if there's an exchange rate regime switch from stable to variable, how participants learn what is the true model of the central bank. One of the things that was investigated is the early Mundell-Fleming model. The early Mundell-Fleming model has some deficiencies. It has limited micro fundamentals, has limited use of expectations. Again, this is not the modern Mundell-Fleming that's in papers these days. This is, the 60s, 70s Mundell-Fleming model. Why such an old model? Because it has the LM curve, it has the IS curve, it has the capital mobility curve, and it gives us the opportunity to ask questions, right? What happens if there's a shift in the IS curve? What happens if there's a shift in the LM curve? One of the things that we had, particularly in Croatia, is that the LM curve is basically highly inelastic and out of equilibrium with these three curves. So we have constantly that treba će mi ploča, zato sam
dobro.
Da.
Smislo da se bude.
Treba će mi ploča. Onda ću nastupiti. Znači, so we have that these in Croatia, for example, the LM curve is out of equilibrium with IS and the CM curve, and it's highly inelastic. So we have that interest rate from local currencies perpetually higher than the interest rates of all the other currencies, which causes a huge inflow of capital, or at least it has up to 2008. And this brings us to basically, very simply, let's talk about the conduct of monetary policy. So when we say conduct is what the central bank does, buy something, sell something. And this is, we have three markets: domestic market for domestic currency. This is the domestic residential money market between banks with some interest rate equilibrium. This is domestic market for foreign currency. So in Croatia, it used to be in Slovenia, we have an inflow and outflow of foreign currency. A tourist brings 100 euros to Adriatic, wants to buy kuna, so there's a domestic market for foreign currency. Same time, same thing, a bank or a company gets a loan from outside the country, they get loan from non-residents in foreign currency, they have to bring it and then sell it for local currency. So this is the domestic market for foreign currency. And then this is the domestic market for credit, domestic credit market. So how does the conduct of monetary policy go? So in stable, we have the LC market, supply demand. We have the FC market, supply demand, and we have the domestic credit market. What happens if there's an inflow of capital? Inflow of capital is going to bring foreign currency, fine. It will destabilize the exchange rate. The central bank will intervene and it will buy foreign currency for local currency. So the curve shifts back, fine. This will increase local currency, so we're going to have an increase in supply of local currency. Okay, increase in supply of local currency will obviously increase domestic credit. simple supply and demand. Okay? What happens if we have an outflow of money? So supply decreases, the economy is out of, the exchange rate is out of equilibrium, central bank has to react, has to buy extra local currency, so supply of local currency decreases, and we have a decrease in the domestic credit market. Again, very basic, very simple supply and demand setup. What we have is that the main spillover effect, on this market there is an intervention, there's a spillover on local domestic market for domestic currency, and then a spillover on credit market. Here's a question. Does economy need this and need this? Depending on the point in business cycle. What has happened in Croatia in 2009, there was an outflow of capital. So much that the central bank withdrew local currency that the overnight interest rate went up to 40%. And then we had a credit contraction. So in the middle of recession, bad times, the central bank has to protect the currency. To what effect? To what end? On these two markets. So when you have a stable exchange rate, if you are a credible committed bank, credible committed central bank, you basically say, this is my ballpark. This is where I operate. What happens here and what happens here, I as a central bank don't care. This doesn't make sense. It doesn't make simple sense because you cannot separate monetary policy from a credit policy. How can you have the 50-60% of your loans are given to households? Why are households getting loans? It violates the prime directive of economics. So what we have is not this. We have savings equals loans. So households save so that households can get loans to buy goods and live above their means. As a central bank, it is my firm belief that regardless of what happens in these two markets, the central bank has to control the structure of domestic credit. It is not the same thing if I get a loan to buy an apartment, if I get a loan to just spend money, especially money on imported goods, or if a company gets a loan, opens a mall, or if a company gets a loan and opens a factory with 500 new jobs. So what we have, and especially in Croatia, under stable regime, that the central bank has simply forgo these two markets. Now, one of the ways to basically change all this is to have a variable exchange rate regime. Under variable exchange rate regime, the central bank can intervene on this market, without being afraid of the spillover effect. So if the central bank says, okay, our banks need more liquidity, it increases the supply of local currency, and there is some exchange rate depreciation. Big deal. That is part of the exchange rate regime. And again, here. Now, you do not need to have a variable exchange rate to control this. You can do this through regulation. You can do this through capital adequacy. You can do this through reserve requirement. You can do this through all sorts of penalties. But if you say, I'm going to have stable, fixed exchange rate regime, then you have to regulate credit policy of the banks through other means and measures. Why doesn't Croatia have a single securitized bond in aggregate balance sheet of all the banks? Because the capital adequacy ponder is 1,600%. So if I buy 1 million of securitized bonds, I need 16 million in capital. Why do that for 4% when I can get a government bond for 4% and have zero capital adequacy requirement? somewhere has to address this market and this market. If you have fixed, stable exchange rate regime, it becomes increasingly difficult, especially now when we are going to get into the economic participants.
Excuse me, I just want to warn you that you have 30 minutes, so please be focused on hypotheses, methods of research, and results. This should be
Yes.
focused on.
It's all
So you can proceed, but
absolutely.
do some adjustment if necessary to focus on this.
Absolutely. This is timed, everything except the methods. I'll do the methods separately and we'll make the presentation. So this is the conduct of monetary policy. We covered it. So what's the deal with households? It's a main economic unit. With the choice of the exchange rate, the economic setup is given to households. That's the box. The main difference will be the amount of debt the households are willing to hold. And the debt runs through the FX risk. Banks are profit maximizing institutions, which basically means that the banks are going to lend to the sector that is most profitable. That does not necessarily mean that it's going to be optimal for the economy. So there is a possibility to have a crowding out effect. Banks lend to households because they make more money off of households instead of lending to companies and firms. Firms are profit maximizing agents, and here we have something called marginal entrepreneur. Let's say I have a certain amount of funding and I say, okay, I'm going to open a new business. I have to choose a sector or a type of a business. Am I going to produce, sell and export, or am I going to import and sell? Is it going to be production of goods, or is it going to be production of services? This is determined through real exchange rate regime. That was the initial hypothesis. It didn't pan out so well. Government, on the other hand, behaves like the households. It functions on a political cycle, not on a business cycle. So the government will want to have as much money to spend as it can possibly get. Now, here's the big thing about the government. Credit-induced VAT. Why does government want stable exchange rate regime? Because there's an increase of household debt. Now, household debt gives more income to the government. Let's go like this. I have no money. I have no income. I go to a bank and I say, hey, give me a loan. The bank gives me 1,000 euros loan. I take this 1,000 euro loan, I go to Mercator, I spend it. What happens with Mercator? The revenue goes up. What happens with the government? Government collects VAT. What happens when there is an upper level of household debt is reached? The credit stops. No more credit-induced VAT. And this is why creation budget is always short. We increased our VAT from 22 to 25%, and it's still not enough because 4 billion is not coming in through credit. The hypothesis and the sub-hypothesis were all tested on these 10 countries. Some of the countries were excluded because of mostly because of political things, like Bosnia, like Macedonia. Poland was too big, so I tried to find a group of countries which is fairly similar. This is the definition of exchange rate regimes. Some were really easy. You look at the value of exchange rate, you see it's flat, fixed all the time. Same thing here. Some had exchange rate regime switches. So this was used to test, was there a change in economic behavior? One of the things that the stable exchange rate regime failed is basically inflation. Stable exchange rate regime doesn't provide not price stability, because price stability is, again, really bad term. Let's talk about inflation stability. The fixed exchange rate regime doesn't provide inflation stability. That's clear from the data. There's basically no need for econometric testing. Under variable exchange rate regime, the source of inflation was mathematically set up as the exchange rate through the pass-through effect, and it's mathematically proven how pass-through effect goes to 1. But under stable exchange rate regime, what is the source of inflation? It could be multiple, and I did not investigate, it was simply not enough in scope. Foreign debt, this is the big variable, and here we see the basically most significant changes, from here, where there's an exchange rate switch, the foreign debt basically quadruples. In Slovenia, this is pretty much, I believe, Yugoslavia, I don't know which number of these two. There's very limited growth of debt, and then the debt explodes. Hungary, flat under variable exchange rate regime, and then foreign debt explodes, stabilizes in the last couple of years. Loans to households pretty much follow the same pattern, go down, exchange rate regime switch, go up. Croatia, flat, with increase here, but then they become the predominant amount inside the balance sheet, and then there's here deleveraging. One of the things that the hypothesis tested and econometrics proved, when there is an exchange rate regime switch, there is a switch in the employment, in the structure of employment. Once you move from variable to stable exchange rate regime, the more jobs are open in services. And this was econometrically tested and it proved there is a statistical relationship between the exchange rate regime switch and the new jobs creation in terms of sector. So here are the variables that were investigated, and here are the results of the model. On economic growth, I put model correct, basically the model is partially correct. There is the largest and the biggest growth are under variable exchange rate regimes in Slovakia, but in terms of the sheer magnitude of growth from 95 to 2008, there is very little of how of proof that variable exchange rate regime leads, or any regime has a more growth optimal. The sources of growth are different. The crisis robustness, it says that the exchange rate regimes with variable exchange rate should be more crisis robust, not correct. Real exchange rate regime model is partially correct. It is not, in the countries analyzed, it was impossible to offset the real exchange rate appreciation, but it was possible to have less real exchange rate appreciation under variable exchange rate regime. Inflation, stable exchange rate regime is no guarantee of low inflation, or inflation equal to countries to which you have stabilized your exchange rate. This is correct. Price stability, again, stable exchange rate does not lead to stable inflation rate. Model correct, because the standard deviation of inflations in different economies is different. For example, Slovenia under variable exchange rate regime has a smaller and more stable exchange inflation standard deviation than under stable exchange rate regime. This, in terms of imports and exports, the ratio model is incorrect. In terms of loans and in terms of foreign debt, the model is correct. Stable exchange rate regime leads to higher household debt. It leads to higher foreign exchange rate debt. So basically the banks are importing funds to finance consumption, and this is, model is correct. In terms of employment, model was econometrically tested through child test, and there is, model is correct, there is an effect of the exchange rate regime switch from this type of jobs which are being opened in the economy. Labor participation rate, model is incorrect. So basically the amount of people which are in the labor market are not impacted in terms of exchange rate regime. Government deficit, this is where the model is correct. The countries with variable exchange rate regime have higher deficit because they do not have credit-induced VAT as part of their income. Total debt, variable exchange should lead to lower government debt. This model is incorrect. Production of goods versus services, this is basically with employment, the source, the structure, the income structure of GDP, the model is correct. In terms of consumption as a part of GDP, and in terms of investments in fixed capital, so the structure of GDP, do I spend, on what do I use my GDP on, the model is incorrect. So what do we see? We see that since this is a highly monetary skewed model, it is a monetary variable spread, foreign debt, banks, loans to households, with some effect on real economy through government. In terms of real economy, which is basically, if I had variable exchange rate regime, am I going to have lower consumption? No, model is incorrect. So it is chicken and the egg argument. If you have a really good economy, variable exchange rate regime helps. If you have a bad economy, variable exchange rate regime cannot save you. These are the individual hypotheses in terms of households. In terms of households, the three hypotheses were confirmed. The behavior is altered. When faced with depreciating exchange rate, the households had credit averse consumption plans. They don't want to hold debt. And if household is faced with stable exchange rate regime, the household will prefer more debt just to consume more money. Firms, variable exchange rate regime will have higher level of employment and higher level of labor participation, not confirmed. More orientation towards services and trade, yes. Different exchange rates will create different economic environments, yes. In terms of banks, again, monetary variable, since this is a monetary participant, we see that it's all correct. So, banks as profit maximizing institutions will give loans to where they can get more money, more profit. Under stable exchange rate, banks will lend more to households than under firms. We show this through crowding out effect. And economies with stable exchange rate will have higher foreign debt, again, confirmed in the data. Government, fiscal policies will have different deficits planned, not confirmed. VAT, higher consumption, confirmed. And because of receipts from credit funded consumption and possibilities to get funds from foreign markets, the fiscal policy will prefer stable exchange rate over variable exchange rate. This was inconclusive. We can basically put it in not confirmed. Central bank, again, monetary participant, everything is confirmed. Central bank chooses the exchange rate. The choice of the exchange rate sets economy on a particular path, confirmed. Changes in exchange rate will change the decision-making participants in the economy, confirmed. Economies with stable exchange rate will have higher level of foreign debt, confirmed. Central bank is more able to control inflation under variable exchange rate, again, confirmed. And as the main thesis, there is a difference in the exchange rate regime. When the central bank chooses the exchange rate regime, there is a difference in economic behavior and choices participants make. In some variables, this choice is significant, debt. In other variables, labor participation rate, it is insignificant. So further research should basically dig more into these effects. Well, like I said, some are covered. I did not know that I need to list the methods. I can do them basically in
you don't need to formally, but it's optional. So may I suggest that we stop your presentation at this moment, because I think that there will be a very interesting discussion in continuation of our meeting. So at this moment is enough, because we are all familiar with your research, and of course because we have a lot of questions, and we have to be very careful with time also.
I took a day off, so
Yes, unfortunately we did not. So at this point, I will ask your mentor, Professor Bashnik, to read some.
Well, this document is written in Slovene, so I read Slovene. Da. Kar se tiče vsebine, ne bi ponavljal, ker jo je kandidat načrtno